Fed's sudden 2025 warning. Halt to interest rate cuts. The global financial war has just begun. At the end of last year, the Federal Reserve announced it would start cutting interest rates. Countless individuals saw this as an opportunity to profit and entered the market before the cuts took effect. Historically, when interest rates declined, they often fell rapidly, sometimes to zero. Once rates dropped, borrowing costs worldwide decreased, prompting people to rush to borrow money for business and investment. Consequently, real estate prices and U.S. bond values soared. People wanted to buy homes and stocks before prices climbed even higher. However, earlier this year, the Fed abruptly reversed course, stating, "Sorry, we're no longer lowering interest rates, and we might even raise them again." The reason? U.S. inflation remains stubbornly uncontrolled. In just a few months, the U.S. interest rate fell from 5% to around 4%, then stalled instead of continuing its expected downward trajectory. In other words, borrowing money in the U.S. remains costly. While the investment logic tied to these rate cuts hasn't shifted, what was once positive news has turned sour. If inflation persists unchecked, and the Fed is forced to hike rates again, global asset markets could face an unprecedented downturn. Will that actually happen? Welcome to FortuneCraft, ladies and gentlemen. You may have noticed over the past few years that whenever the Fed raises interest rates, money flows globally into the U.S., causing other currencies to lose value. As a result, many countries are compelled to increase their own rates to prevent their domestic currencies from devaluing too sharply. However, with numerous nations already grappling with economic challenges due to pandemics and wars, raising rates further increases borrowing costs. This discourages investment in those countries, weakening their economies even more. For instance, the UK bond market is nearly stagnant because buyers are scarce. The Japanese yen has plummeted to a historic low. Germany, Europe's largest economy, has seen its gross domestic product decline as the global economy falters. Yet the U.S. economy remains robust. Money from around the world is pouring into the U.S., driving up the dollar's value, strengthening America's global economic position, and boosting its stock market. This is how the global financial system tilts in favor of the U.S. Last year, many countries grew fed up with this dynamic. When they heard the Fed might cut rates, they acted swiftly, lowering their own interest rates to bolster their struggling economies, until the Fed actually followed through. These nations continued slashing rates further, buying themselves some room to recover. But now, with the Fed's sudden announcement that it won't lower rates after all, those countries having cut rates so deeply can't raise them again to close the gap, as their economies can no longer withstand the strain. Nor can they keep cutting rates indefinitely. The Fed's failure to lower rates effectively acts as an indirect rate hike. This widens the interest rate disparity between the U.S. and other nations, once again funneling global cash flows into the U.S., as noted earlier. Gold prices are surging as the world trades its currencies for gold, devaluing global currencies further. In essence, the blood-sucking season persists, draining global cash flows and forcing the cheap sale of assets worldwide. The countless assets people have worked hard to build could vanish in an instant. Is it true that the Fed can't lower interest rates? And what can we do to protect our assets, or even seize this opportunity to profit? If you don't want to be a victim, follow my channel, where I provide valuable insights. I'll bring you more updates and analysis. Subscribe and stay informed. If you're worried about missing details, click the notification bell to get alerts for my next videos. They'll automatically save to your playlist so you can revisit them anytime and follow the necessary steps. Right now, the most critical thing is understanding why the Fed insists it can't reduce rates because inflation remains untamed. Have you ever wondered why U.S. inflation hasn't subsided? Is it because the U.S. economy is too strong, or are people simply spending too much? Do you know why there's a culture of unchecked consumption? In some U.S. convenience stores, you can take items without paying, and the police won't arrest you. It's practically legal. If the U.S. economy is truly thriving, why are major corporations like Amazon and Tesla laying off tens of thousands of workers, not just a few hundred? For instance, Facebook recently announced it's cutting another 10,000 jobs. Why is it that when the U.S. economy is supposedly strong, actions like overlooking theft due to legal or systemic changes are justified? If the economy is flourishing, why the push to change presidents? When someone claims inflation is rising because the U.S. economy is booming and the Fed must delay rate cuts or even raise rates to regulate the market, is that really credible? If you argue that people fear Trump might impose higher import tariffs, making future goods pricier, and driving them to buy essentials now, thus fueling inflation, that bolds some logic. After all, most U.S. goods rely on imports. Take avocados. 90% of those used in U.S. salads come from Mexico. If Trump slapped a 25% tariff on Mexican imports, would people keep buying avocados? When everyone rushes to buy, prices naturally spike, stoking inflation. But that's just a short-term effect. What's the real root of inflation? It's more money chasing fewer goods. What does that mean? Let's look at this graph. What do I mean by more money than goods? If we examine the graph from 2020, when the pandemic hit, it shows a sharp rise in money supply. Think of it as printing more money. The yellow line jumps from $4,100 billion to about $9,100 billion, meaning the Fed injected roughly $5,000 billion into the market. Then, starting in 2022, the Fed began shrinking its balance sheet by pulling money back. The yellow line drops from $9,100 billion to around $7,000 billion, a withdrawal of about $2,000 billion. So, while the Fed added $5,000 billion, it's only reclaimed $2,000 billion, leaving over $3,000 billion in new dollars circulating. Many noticed the shrinking balance sheet and assumed a massive amount of money was withdrawn, but in reality, more than $3 trillion remains in play. Few realize the Fed recently announced it will halt this reduction, meaning it won't keep recovering those excess funds. That $3 trillion will stay in circulation. Where's it going? The Fed will use it to buy U.S. government bonds, effectively lending to the government, or lend it to banks at near zero rates. Banks then lend it to capitalists for production. In theory, more money and goods balance out inflation and spur growth. That's the U.S. economic playbook. Economists still pitch this to reassure us. But there's a catch: capitalists must use that money to produce goods. That's the assumption, rational behavior. But what's the reality? In 2020, with the pandemic paralyzing the U.S. economy, the Fed printed money on a massive scale. If you're a capitalist with access to cheap, near-zero-rate loans, would you invest in factories, hire workers, and ramp up production? If you're a CEO, your job isn't to make the company thrive, it's to maximize shareholder profits. So when you get that money, you don't have to build anything. You can just pump it into the stock market, buy your own company's shares, and drive up the price. That's why in 2020, after the pandemic crashed the U.S. stock market by 30% in a month, it quickly rebounded and soared higher than ever. Not because the economy recovered while people worked from home, but because fresh money flooded the market. The U.S. printed cash, lent it to capitalists, who then legally inflated their stock prices, luring small investors to pile in. Meanwhile, ordinary people faced rising prices. In short, It's a massive wealth transfer. Inflation erodes savings as costs climb, while capitalists' assets balloon with soaring stock prices. The money printing sparked such severe inflation that within 2 years, the Fed had to raise rates. But does raising rates shrink the money supply? Higher rates can limit business investment and leverage, sure. Yet, as we've seen, when U.S. rates rise, global money converts to dollars and flows into U.S. banks, strengthening the dollar and drawing even more cash worldwide. Prices keep climbing, and investors, knowing the U.S. flooded the market with money in 2020, see stock prices spike and pour funds into U.S. markets. That's why, despite rate hikes last year, the U.S. market thrived. Stocks boomed as global money chased returns. When rates hit 5%, billionaires like Warren Buffett, Bill Gates, and Mark Zuckerberg cashed out, doubling their cash reserves. Buffett, for example, shifted from stocks to cash, then bought U.S. government bonds, mostly short-term ones, from 3 months to a year or two. Today, 90% of U.S. bonds are short-term. When they mature, the principal returns, letting capitalists lend to the government briefly, while eyeing new opportunities as rates shift. Right now, the 3-month lending rate outpaces the 10-year rate. In plain terms, capitalists are heavily lending to the U.S., extracting its resources. Normally, lending over 10 years earns 2–3%, but now they demand 4 to 5% in just 3 months. If those rates aren't met, no one lends. So, why is the U.S. government overspending its budget? Historically, it repaid loans over 10 years, but now it's every few months or a year. If it can't pay on time, it borrows anew to cover old debts at higher rates. Trump keeps pushing for sharp rate cuts. Why? Simple. The U.S. Treasury has just $700 billion left. Too little to sustain current spending. Lower rates would slash borrowing costs fast. If I owe you $1 million at 5%, that's $50,000 in yearly interest. But if I borrow $150,000 at 1% to pay you, my interest drops to just over $10,000. A rate cut would let Trump assure voters' welfare won't shrink while slashing government spending. But if rates fell to 1%, would capitalists still lend? If rates tank, who'd buy short or mid-term bonds? Wouldn't that choke the capitalist profit pipeline from the government? Some call this a conspiracy, but look at the facts. The Fed printed money. The government borrowed it, then lent it to capitalists at zero rates. Inflation surged, eroding people's wealth while capitalists cashed in, jacking up asset prices, selling high, and lending back to the U.S. at high rates. Rinse and repeat. If you miss the big picture and rely only on theory or financial reports, what do you do when the Fed hikes rates? Sell stocks, thinking growth will slow. Last year, that meant missing huge gains. You could have bought blindly and profited. Now, with rates dropping, you jump in, but the index swings wildly up then down. Volatility makes it tough. Even in a bull market, 80% of investors lose. Profits are harder to lock in. People buy dips and sell peaks. Today's U.S. stock market strategy: guerrilla tactics, strike, profit, retreat. No long-term fights. Why did the Fed help capitalists profit? It's a capitalist institution, born from families like the Morgans, who bailed out banks during crises like the San Francisco earthquake. They saw that economic trouble didn't just hit banks, it froze money flows, risking their empires. A trusted central bank was needed to lend emergency funds. and save banks from collapse, preventing a domino effect that could tank the U.S. economy. The Morgans pushed for a bank free of government control. The Saturday Evening Post's founder described it: a group wielding a quarter of the world's wealth slipped onto a private train at night, traveled hundreds of miles, and hid on a near-empty island with a few servants. For a week, they plotted a scientific monetary system, using no names to shield their identities. After days of debate, they birthed the Federal Reserve. Today, whether Trump wants to fire its chair or slash rates, the Fed resists. It answers to its true masters, the world's richest capitalists. It's a temple guarding elite wealth and power. Congress balked in 1913, but the law passed. During wartime, defense firms ruled, raking in weapon profits. Post-war, their earnings crashed, yielding to financial giants who thrived on stock, bond, and virtual product trades. Effortless global wealth extraction. So why doesn't the U.S. government rein in financiers? Politics serves capital. It's no secret. When inflation climbs but rates don't drop, capitalists lend to the government at high rates. Global currencies, like the yuan, weaken. Capital floods China, fueling AI leaps via firms like DeepSeek. Chinese and Hong Kong stocks surge as Wall Street pulls back. Yet the yuan keeps sliding, letting U.S. capitalists buy Chinese assets cheap with dollars. They criticize DeepSeek, but hype its potential, drawing global eyes. That's why Chinese and Hong Kong markets are booming. Apple's new Alibaba tie-up spiked Alibaba's U.S. trading volume after years of decline. U.S. funds are quietly scooping up these assets. I'm not pushing Chinese or Hong Kong stocks, don't misunderstand. We're just tracking trends, not predicting. We invest on facts, not guesses. Here's the kicker: Canada's signaling moves. Check my last video for context. Canada often leads the Fed on rate shifts. If Canada eases, the Fed might soon expand its balance sheet with sharp rate cuts. But didn't I say cuts hurt capitalists' profits? Yes, so bond yields likely won't drop, though bank deposit rates might crash. Your savings could earn nothing, but buying bonds might still yield high returns, forcing money into bonds. If rates hold, capitalists keep bleeding the government. If cash runs low, the Fed prints more, lends to banks at fixed rates, and banks buy high-yield bonds while the Fed manages expectations. Just my hunch, time will tell. I'll stop here. I share free tips on wealth, entrepreneurship, investing, and financial freedom. Don't miss out. Subscribe, hit the bell, and share this with anyone who needs it. I wish everyone who likes this video financial freedom soon. If you find one or two useful nuggets here to improve your life, that's enough for me. I'm FortuneCraft. Thanks for watching. Goodbye.